Welcome back to the Fire Grind. My name is Daniel, and on this channel we talk about personal finance with a focus on the stock market. And in today's video, I'll be going over two different stocks that I've talked about previously on this channel. The first one is the Very Good Food Company, and the second one is Drone Delivery Canada. And both of these companies recently released some interesting news, so I'll be going over each of these companies. So first off, let's start with Drone Delivery Canada. Drone Delivery Canada recently released a capital raise that they're doing, so we'll be going over this piece of news here. So the original offer that Drone Delivery Canada came out with was they're looking to raise $5 million by offering 7.1 million shares at a share price of 70 cents per share. So that's actually around 16 cents lower than the closing share price that date. However, they renounced the offering and actually revised it such that they're raising $8.05 million and up to a maximum of $9.257 million, and offering 11.5 million shares at a share price of 70 cents per share. And management stated that the purpose of this raise was to expand the company's international prospects, increase staffing if needed, and developing new projects, and for general corporate expenses. What's interesting here that you guys might have picked up on was that the offering actually stated a share price of 70 cents versus the closing price of 86 cents. So this feels like a low blow to investors because they're offering the shares for a lot lower price than what you and I as retail investors can buy the shares for. However, you should note that when companies are offering shares as a secondary offering, they always have to offer it at a lower price in order to entice buyers to buy large chunks of shares. Otherwise, they might as well just buy them on the open market. And after the announcement, you'll notice that the shares of Drone Delivery Canada actually dropped down to 73 cents that day, and it dropped by 15%. And this is due to the secondary offering being offered at a lower price than the current market value. So investors sold off their shares because of the dilution that happened, and this ultimately devalued the company a little bit. And just so you guys know, this doesn't always happen because companies like Shopify and Tesla who raise capital, investors might actually see this as a positive sign because this is the company taking more cash in order to be able to continue fueling their growth. However, I think investors in Drone Delivery Canada don't have as strong a conviction as they do about other companies like Shopify and Tesla. And this is ultimately why it sold off. And one thing we should note about this company is that if you're looking at the history of its market cap has actually been dropping over the past 2 years since February 2018. And this is when they hit their all-time high of $330 million as a market cap. And I think this market cap hit just after they announced the Raven. And this is one of the drones that had a capacity of 25 pounds. But since then, the market cap has continued to drop all the way down to $137 million today. Or I think according to Google Finance, it actually dropped down to $126 million. If we look at the previous share offering, which happened in March 2019, the company offered 6 million shares at a price of $1.20 per share, and they raised $7.2 million. So with this capital raise being higher than the previous capital raise, it seems like Drone Delivery Canada's expenses to grow are increasing. And this is only natural for a growth company because in order for companies to grow, they have to funnel more cash in and speed up development. And for Drone Delivery Canada, they decided to speed up development because they saw a need for their product in light of COVID. I believe many investors who looked into the financials of this company, including myself, saw that Drone Delivery Canada needed to raise capital in the near future. And this is because the company is currently not profitable, nor do they bring in much revenue at all. In the previous quarter, that was their first quarter that they actually generated some sort of revenue. And that revenue was $2,545. Yep, you heard me right. $2,545. That's how much a person on minimum wage makes in about a month and a half. And on top of that, their net loss for that quarter, so the latest quarter, was actually $4.1 million. Compared to the previous year, the same quarter, it was around $3.7 million. So this company is burning through a lot of cash. But the reason they're burning through so much cash is because of the nature of their business. They're creating drones, and this technology needs to be tested before it can actually generate some revenue. But the fact that they actually generated some revenue, it shows that they're ready to move from research and development into commercialization, which is very exciting for the company. And I believe management sees this opportunity right now to raise capital because the share price back in March when COVID hit dropped to around 50 cents. And before the raise was announced, the share price was at around 86 cents. I think management decided not to risk it and hold off in case a second wave of COVID hits. And we know that in the States and other parts of the world, they're already seeing a second wave. So therefore, management raised capital now before any sort of other risks come into the market, dropping their share price any further. And as a small cap stock, these stocks get hit the hardest whenever there's some sort of turmoil in the market. And I think this capital raise was not exactly ideal for Drone Delivery Canada, and they were not banking on COVID happening and the stock price being hit so hard. But, life is life, and when life throws you lemons, you just got to deal with it. And for shareholders, we're seeing a lot more dilution because the company is actually valued a lot less than the previous raise, and therefore, more shares have to be issued in order to raise a similar amount. And for shareholders, this is not great news because in the previous round, they were able to raise more capital, giving away less equity. However, with the market cap dropping because of COVID and everything else that's hitting them, each share that they offer right now does not get them as much as the previous round. But in order to cover the next 10 to 12 months worth of expenses, management knew they needed to raise some capital, and they probably raised a little bit extra as a factor of safety here in order to keep the business alive. And ultimately, if the business fails, as shareholders, this is worse off for you than some dilution. And I think the stuff that Drone Delivery Canada is doing right now is very attractive to me as an investor. They've proved that in the drone space, they're one of the only companies that can actually generate revenue. And this is because they got their aircraft certified as well as their business model. They're tackling more remote areas to do delivery versus other companies that are really focused on delivering into the residential areas like Amazon and UPS. So Drone Delivery Canada is already able to prove that their technology can generate revenue, they actually have paying customers, and they're able to show their product going forward having some sort of business use case. Versus other companies who are developing drones for residential delivery, they don't have as much track record of running a drone delivery business compared to Drone Delivery Canada. And I think going forward from here, Drone Delivery Canada will continue to attract more contracts coming in. And when that starts to happen, the share price should move up in step with that. And with a market cap of $122 million and the whole drone delivery space being roughly estimated at $29 billion, I think the risk to reward ratio is in favor of investors here. And this is why I'm still invested in Drone Delivery Canada and I'm not afraid to buy shares at this level. Now moving on to the Very Good Food Company, and this company actually IPO'd this year on June 18th. And not even after a month of being a public company, they decided to announce a secondary offering already. And let's dig into why they're doing that. So the bought deal offering for the Very Good Food Company is as following. They're offering 4 million shares at a price of $1.30 per share, giving the company total proceeds of $5.2 million. Each share comes with a half warrant, which can be exercised in the following 18 months at a price point of $2 per share. And an additional 600,000 units of shares can be purchased by the buyer, bringing the total possible proceeds to $5.98 million. And the company states the purpose for this offering is to 1. Expand into the US, 2. Continue investment in its product portfolio through research and development or acquisition, and 3. For general corporate expenses. And if you look at the stock charts, the day after they announced this, the stock dropped 4%, but since then has rebounded and increased by around 23 to 24%. Now when we look back a month ago when the company went public, they sold shares at a price of 25 cents per share. And now having the opportunity to raise cash at 5 times the original IPO offering price, it's a no-brainer that management would leverage their high stock price to raise more cash for expansion. And again, with the COVID risk and big plans ahead, this seems like the perfect time to raise cash. And if you're management looking at these times right now, and you're seeing your stock price 5 times from your IPO price, I'm sure you would agree with raising capital right now. And I think the stock price did not fall to the secondary offering price like Drone Delivery Canada because investors have seen triple-digit growth in site visits, average order values, number of orders, and conversion rates. Not to mention in my previous analysis of this company, which you can check out in the link above and in the description down below, they released a statement showing that sales grew by 1,000 to 2,000% in the months of March, April, and May compared to the previous year. So who knows what they did for the month of June or July? That will come out soon. After raising $4 million from their IPO and $6 million from this next round of financing, the company will have a total cash position of $10 million. This gives them a lot of cash to expand into the US as well as grow their Canadian operations. And I think the demand that they're seeing for their product is actually what triggered the secondary offering happening. Because last time I looked on the website, which was a couple weeks ago, when I did that Very Good Food Company stock analysis, they had roughly a delay time of 3 to 4 weeks. But today, when I went onto the website, they actually had a delay of 4 to 5 weeks on any orders. So you can see that there's a lot of demand and they're not able to fulfill that. So therefore, the secondary offering is going to help them increase production as well as do any other sort of expansion activities. So this is a very smart move in my opinion that management took advantage of their high share prices in order to expand their operations during COVID right now. And for those of you guys who are hating on this company because it's a spec play, I understand that it is a spec play. However, there are a lot of tailwinds that are playing in the favor of this company, which is why I'm currently invested in the company and plan to continue adding more shares going forward from here. And if you guys are looking for these shares on Wealthsimple Trade, they're not there right now just because of the nature of the stock and it doesn't meet Wealthsimple's requirements. However, if you do open up a QUESTRADE account with the link down below, you can find the Very Good Food Company on there. And when you use the link down below to open up a QUESTRADE account, you can get $50 in commission credits. So that allows you to average into the Very Good Food Company around 10 times if you want to do so. If you enjoyed this video, smash that thumbs up button as well as leave any comments that you have on both these companies. And hit that subscribe and notification bell for more Canadian stock analysis in the future. Keep up the grind and have a great day.